Stock. Think of a stock as a small piece of a company. If you own a stock, you own a part of that company and share in its profits and losses. It's like owning a slice of a pizza. The bigger the company or pizza, the smaller each slice might be, but it could still be quite valuable. Bond. Bonds are essentially loans you give to companies or governments in exchange for periodic interest payments, plus the original loan amount back after a certain period. It's like lending money to a friend who pays you back with interest. Dividend. Imagine a company making a profit and then deciding to give a portion of these profits back to its shareholders. That payment is called a dividend. It's like a reward for putting your trust and money into the company. Market capitalization. This is the total value of a company's shares of stock. You calculate it by multiplying the current stock price by the total number of outstanding shares. It helps investors determine the company's size compared to others. IPO, initial public offering. This is when a company first sells its shares to the public. It's akin to a private company stepping onto a bigger stage to let everyone buy a piece of it. Index. An index tracks the performance of a group of stocks, which represents a segment of the stock market. It's like a thermometer for the stock market's health. Bear market. This term describes a stock market where prices are falling. It's named after the way a bear swipes downward. It's not just a few stocks dropping. It's when the whole market trend is pointed down. Bull market. Opposite of a bear market, a bull market is when stock prices are rising. The term comes from how a bull thrusts its horns upward. This is generally a sign of economic strength and investor confidence. ETF, Exchange Traded Fund. ETFs are like baskets of stocks that are traded on stock exchanges, similar to individual stocks. They offer a way to invest in many stocks or bonds at once, which can help reduce risk. Blue chip stocks. These are shares of large, well-established companies known for their reliability and financial stability. They're like the aristocrats of the stock market. Day trading. This is the practice of buying and selling stocks within the same trading day. Day traders are like the sprinters of the investing world, looking for quick profits. Volatility. This refers to how much stock prices fluctuate over a short period. High volatility means the price of a stock can change dramatically in either direction in a short time. Margin. This is when you borrow money from your brokerage to buy more stock than you can afford with your cash on hand. It's like using your credit card for a purchase you don't fully have the cash to cover. Short selling. Imagine you borrow a stock from a broker and sell it at current market prices, hoping to buy it back later at a lower price, return the shares to the broker, and pocket the difference. It's a bet that the stock's price will drop. Broker. A broker is someone who buys or sells an investment for you in exchange for a fee, a commission. Think of a broker as a matchmaker who finds someone willing to sell what you want to buy, or buy what you want to sell, and then charges you for this service. Options. These give you the right to buy or sell a stock at a preset price before a certain expiration date. It's like having a coupon that lets you buy a product at a guaranteed price before the coupon expires. Futures. These are agreements to buy or sell an asset at a future date at a price agreed upon today. They are commonly used for commodities like oil or gold. Liquidity. This term refers to how easy it is to buy or sell an asset without affecting its price too much. High liquidity means you can quickly sell your investment without dropping the price. PE ratio, price to earnings ratio. This ratio measures a company's current share price relative to its per-share earnings. It helps investors assess if a stock is overvalued or undervalued compared to its earnings. Beta. This measures how much a stock is likely to move relative to movements in the overall market. A beta higher than 1 means the stock is more volatile than the market, while less than 1 means it's less volatile. Bid. This is the highest price that a buyer is willing to pay for a stock. It's like haggling in a market. The buyer says, "I'll pay this much." Ask. The ask is the lowest price at which a seller is willing to sell their stock. It's the counter to the bid, where the seller says, "I won't take less than this." Spread. This is the difference between the bid and the ask price of a stock. A narrow spread means the stock is liquid. A wide spread could indicate less liquidity. Market order. This is an order to buy or sell a stock immediately at the best available price. It's straightforward but risky if the market is volatile. Limit order. This is an order to buy or sell a stock at a specific price or better. It ensures you don't pay more or sell for less than you want. Stop loss order. This type of order is designed to limit an investor's loss on a position. It automatically sells a stock when it reaches a certain price. Portfolio. This is the collection of all your investments, which might include stocks, bonds, ETFs, and more. It's your financial inventory. Yield. This refers to the earnings generated and realized on an investment over a particular period, usually expressed as a percentage. It's like the interest rate on a savings account. Capital gain. This is the profit that results from a sale of a capital asset, such as stock, when the selling price exceeds the purchase price. It's the financial reward for a successful investment.